I can't do it.
Okay.
We'll do it live.
Okay.
We'll do it live. Fuck it. Do it live. I'll write it and we'll do it live.
Right.
Fucking thing sucks.
In 5, 4, 3.
Anyone claiming that America's economy is in decline is peddling fiction.
I've abandoned free market principles to save the free market system.
But we have to pass the bill so that you can find out what is in it.
Raising the debt ceilings does not increase our debt. It does not somehow promote profligacy.
I know words. I have the best words. Nobody knows the system better than me, which is why I alone can fix it.
Hey, what's going on, everybody? Happy Friday, and welcome back to the F.I.R.E Portfolio, where we're going to manage a portfolio together to hopefully put you on the path to financial independence and being able to retire early, hence the acronym. So I know I missed this one last week. I didn't give any updates. Last week is actually when I took the last couple of trades in this account. But I think I told you the trades that I was going to do the week before, so I didn't really feel a huge necessity to go over what I had already said I was going to do. This week, I did not really do much. Let me pull up the portfolio here. It's right here. Okay, so this is what we got. Let me just make sure that looks okay. Yeah. We still have our Amazon position. Remember, this is a LEAP, a long-term options call that we bought a while ago. We have one contract at the strike price is 300 for December of 2028. Now, Amazon just had a really nice earnings beat last night. And the last 2 days have been pretty kind to this stock. So we are up at, where's Amazon right now? Is it at 270? Hang on. Amazon. God, yeah, the fucking lag. I don't know what I did to this fucking laptop to make this retarded, but I can't fix it. Whatever I did, I can't undo it. I've tried undoing everything. 271. So yeah, if we want to look at that chart, let me remove this for a second and pull up Amazon. We can take a look at that chart real quick. I mean, this is a pretty long-term holdings. So again, we're not too concerned with this position, even though it is up nicely now. It was down a little bit a couple days before. And there it is. Okay. So you can see we had this nice big run up to about where we're at right now, about 275. And then it broke down sort of over the last couple of months with it went down with all the other AI. And then a lot of these AI companies, they're to be the biggest winner of this whole AI thing, just given the fact that they wear so many different hats and they have all the infrastructure built out. Like they're a chip company. They're going to make billions of dollars off of their chips. They have data centers. They have fulfillment centers for when AI eventually starts delivering goods to people. So I think they're going to do very well over the next few years. So I'm very bullish on them long term, which is why I took a long term leap. Now, if I had the money, I probably would have just bought these shares outright. But since we are playing with a very small portfolio here, I used the leverage of options to get us a position here. And you can see 2 days ago, it was down below our entry at 227. And then Friday, was that last Friday? No, yesterday. Had a nice day, nice little pop yesterday, and then they just blew out their earnings last night. Earnings estimate was $1.82 per share, and they reported $5.75. And the revenue also went up, surprise to the upside, by $3.5 billion. So they had a pretty good earnings call, and the stock was up substantially, closed about 271 today. So that's why we saw such a big pop in the rest of the portfolio, in that trade in the portfolio. Grab has not had a good 2 weeks. We basically got in at a short-term top at just under $4 a share. And it quickly, over the next couple of days, of course, true to form, dropped down to like 340 or something. So we're down about $75 on that position right now. It was up $7 today. Those are the December 2028 $4 calls. So we basically bought some at the money calls, long-term options. And again, just not really concerned with that trade. Grab, if you don't know, is sort of like the Uber of most of Asia, particularly Southeast Asia. It does operate in Japan, but when I was in Japan, I actually didn't use much Grab. They had Uber there, but Vietnam, Thailand, Singapore, I think, yeah, they're using a lot of Grab there. So again, long-term position. When these do, if and when these do go into the money, it might take Amazon a while to get above 300. Might take Grab a while. Once they do, we can start doing the poor man's covered call strategy on them. And if and when that happens, I will show you guys how to execute that. Our Ford positions, if you want to see the Grab chart, let me just pull that up. It's right here. So yeah, we had this nice movement here. This, what I was seeing in the chart, basically, I think we went into it on maybe on July 7th or something. We had this really nice downward movement into a buy zone and a rejection out of it. So I was liking what I was seeing in the trend line that I had drawn in here. We didn't even really touch it on this latest pullback. And maybe I should draw it a little better. That doesn't look very good. Everybody does draw their lines a little differently, but yeah. So you can draw it like that using sort of the bodies of these candles, but using basically the highs of these candles. And again, it's still providing support. We actually didn't come all the way down and touch it. So still looking technically fine. And we might just be in a little consolidation sideways pattern here for a while. Again, no big deal. Still got about more sense to keep the chart up instead of showing you guys the portfolio, and then we'll go through the portfolio after that. Our Ford position expired worthless. We had some Ford puts that we sold. I'll show you that chart and why I didn't put on more this week. So last Friday, I think we had $14 puts and it closed at $14.36. So those expired worthless. We just collected the premium. It wasn't much. Ford doesn't really have a lot of implied volatility, so the premiums aren't very juicy. But, you know, it was like $40 or something like that. And then you can see this week, it just had you know, Monday was a big up day. Tuesday was an up day. And then it had earnings on Tuesday night, I think it was. Yeah, Tuesday night. They beat earnings. And the stock gapped up on Wednesday. It ended up closing down, but it opened at 1558, rallied out of the gate to 1630. 1630, and then ended up closing down, but still at like $15.25. The next 2 days were down days, but they just weren't to a level where I felt comfortable selling the put. We kind of got there today, but I wasn't in front of my computer to be able to place these trades today. You can see this this gap here in price, this volume imbalance. Isn't that interesting how it created that? And it hasn't painted a body over it, but it keeps wicking down into it almost perfectly. I expected to explore this area a little more, sort of in the mid 14s. So if I'm going to sell a put, I'm going to try to wait for it to retreat a little farther, or put in some sort of structure in here that shows me that we're pretty safe to the downside. But if we were to do something up here when it was at 15, the next 2 days, you're way down on the stock now. The odds of it getting back up there in a week are not super good. So we are trying to avoid getting assigned these things. I mean, I'm not really looking to have Ford in the portfolio. If we do have it in the portfolio, ideally we're assigned in and around our strike price so that we can sell covered calls around it. And again, Ford does not have a lot of implied volatility. So if you're down more than like 50 cents, it's going to be tough to sell covered calls against that and collect meaningful premium. So yeah, going to wait to see, kind of what happens next week. If we get another big down day, I'll probably sell a put or two into that, kind of into this structure that we have here. And again, if you just want to do a basic fib retracement here, we're kind of right at the 50% mark. We did dip down and almost hit the 618. Isn't that interesting how these things just kind of, let me draw it in properly. Swing high to swing low. And I mean, look at that. Look at that. You want me to zoom in a little farther? I mean, that is basically perfect price delivery to the 618 retracement. I'm sure that's totally random. Okay. So if you were looking to buy to get into Ford, that might have been a decent level to try to target and see if you can get it filled there. I had a cleaning lady here all afternoon. I couldn't watch the I might have tried to sell something right at that. When it got down to 14.44 or something, I might have sold a $14 put again. But the way this looks to me, we could explore back down around 14 again sometime soon. So we'll keep an eye on that. Let's see what else we got in here. The Highcroft long-term, well, not long-term. We sold in August 21st put at 19 when we did the one for July. So the one in July expired worthless. We collected that premium. And we also sold one at 19 for August. So here we got our zones drawn out here. I think this big zone is like on the weekly chart, maybe. I must have been looking at, or maybe it's even the monthly. That's a pretty big gap there. Is that on the monthly chart? Yeah. Okay. So that's just a big, we call that a suspension block. You see how there's These bodies are not touching on top or below. All right, and from wick to wick, there's also there's no price action in between here. It was all up movement. So that's just the zone I had drawn out on the monthly. If you want to zoom out and look at what this looks like on a monthly basis, it has not been a good since February. February was the last up month, I think, for precious metals. They might have closed this month up just barely. I think they did. Yeah. So gold finished the month slightly higher, but it's still looking like there's going to be another leg down here to me. I'm anticipating a move up toward the high of this previous month around 4,200, and maybe explore this gap in here. Right there. So it would not surprise me if we hop up there over the next couple of weeks. But unless we get a really strong move through it, I'm expecting that to serve as resistance to take us down. And we got these nice relative equal lows here. And again, this big green zone that has not been explored. So I would not be surprised if we see gold dip down below 3,800, to be honest, in the short term. So we're gonna have to be a little careful there with the HYMC puts, as I told you on the last one. It's sort of serving as a proxy for us to trade precious metals at a high implied volatility with a low dollar price, because we want to be able to afford 100 shares, and at $19 we can afford it. Most of these other stocks are, much higher. We can't really afford to buy 100 shares if the put moves against us. This trend line I drew there, is that a weekly trend? Let's have a look. See. Yeah. Or is that might be on the daily? Is that on the daily? Yeah, it's on the daily. So on the daily, like, we're still above it. Let me get rid of some of this lipstick here. And we're above the midpoint of this big gap here on the daily chart. So you can see that midpoint is providing some level of support. You can see, yeah, we dipped below it here briefly, but immediately got back above it, closed up above that and the trend line that was providing support. And we've been above that ever since. And that was Tuesday. So for the last 10 days, we've been above it. And every time we touch down, we get these nice reactions off of it. So that's encouraging to see, which is why I wouldn't be surprised to see this move up into the, the mid 20s or something like that. If we get another move down, depending on when it is, maybe I'll sell one more of these because the premiums are pretty fat on it. And I'm pretty bullish on precious metals long term. So if we get stuck holding this one, now this one doesn't pay a dividend or anything. So getting stuck holding this one is not great. But if you can keep selling covered calls on the other side of it, again, you'll be collecting a lot of premium. As long as we don't get a huge gap down, we're down like 25-30% on the position, we can still be making money while we hold this, especially if it just sort of chops around in this range right here. That would be really nice. Okay, let's see. What else? That one's done. So we got IWB and NVIDIA. Those are the two other options positions we had open. Let's check in on IWB. We're down a little bit on this one. This is the Russell 1000. We have the February 27, 450 calls. One contract on there. So if we pull up the chart here, we're looking at 450 by February of next year. And this, again, it's been down the last couple of days, and yesterday and today had a nice rally. This is looking very bullish to me still. We're consolidating, but if you look, we're putting in higher lows. So we had this low back in June, and the next low at the end of June was higher than the previous one. And then this one here on this big down day on Wednesday, when the Fed didn't cut rates, and yeah, there's all kinds of noise. Citadel was pulling some shit. This low is still, even though it was a huge move from 404 down to 399. It's a big move for this stock or this ETF. It's still higher than the low before it, and then the next 2 days we got a nice rally from there. But we have dipped below this trend line that I drew in here, so there'll probably be some resistance there. But we got these really nice relative equal highs here. That's just too smooth for my liking, so I expected to attack those pretty vigorously soon. Okay. So we're still, still fine on that position as far as I'm concerned. I don't see any reason to worry about it at this point. Got a lot of time for that trade to play out. NVIDIA also had kind of a rough week before today and yesterday. They got beat up with all the other AI stocks. But it's basically right back to where it was when we put the position on. It's maybe a little, I think we put it on around 203 or something like that, 204 maybe, and it's at 200. So yeah, didn't have a great week in their last 2 weeks really, but I still feel pretty comfortable with this one as well. And what was our, I have a couple different positions on, and this one in real life as well. Okay, so this is the January 28, 240 calls. Okay, so yeah, again, a lot of time for that to play out, and 240 is really not a big ask by January of 2028, about a year and a half from now. So, yeah. All right. Let's see what else we got. So the other trades that I did last week, there were 3 of them. And they were basically all real estate plays. So what I told you I was going to do was take about 30% of the portfolio and put it into real estate in some way, shape, or form. Now, since we can't buy physical real estate, which I would recommend doing if you're trying to build the best portfolio for yourself over the long term, real estate is best purchased physically. You get all the tax benefits. You get to leverage your money with a mortgage, and you can get, you can generate good rental income or something like that. So ideally you would just be buying real estate. Obviously we can't do that. So what I did was I took 30% of the portfolio and divvied it up between 3 different real estate investment trusts. And those were DLR, which is right here, Digital Realty Trust. Okay, and our timing was not great on that one. I think we're kind of right even after, a week of down days. We're about right back where we got into it, I think. Let's see. But again, I'm not too concerned with our timing on this. Yeah, we're up about $132 on the position. We bought it at 173.24. So what these are going to do, this one is sort of exposure to tech-centered real estate, data centers and things like that. So that's going to be a portion of it. And they do pay dividends. So this pays, let's see what this dividend is. Bear with me here. So it pays a 2.53% dividend. PA ratio is a little high at 94, but that's all right. So what we're doing with this, and I'm going to have to see, this looks like it pays quarterly. Yeah. So I don't know how this virtual simulated trading thing is going to handle dividend payments. I'm not exactly sure how that works. We'll have to. This was your hypothetical portfolio. And again, this is all for educational purposes only. I'm not specifically recommending these stocks. I'm just kind of teaching you an approach on how to get a portfolio started. What you would want to do in this scenario is you're buying this and then you're turning on the DRIP, the dividend reinvestment program. So what that will do is every quarter when this pays you, what does this pay us? Every quarter, this is going to pay us $1.22 per share. So with the DRIP on, it will automatically take that dividend payment and buy as many shares of the stock as it can on the payment date. And we're just going to do that in perpetuity. We're not going to think about it. We're not going to concern ourselves with where the price is. If it's up, we're going to buy more. If it's down, we're going to buy more. Every time the dividend comes in, it gets reinvested into the stock. And over time, what that's going to do is it's going to start compounding. We're going to own more and more shares, which means our dividend payments are going to get larger and larger. And ideally, the stock goes up as well. But even if it goes down, then we're sort of dollar cost averaging into a better price, better cost basis on the position. And hopefully you're going to look up in 10 or 15 or 20 years or something, and you're going to have a really nice little income generating real estate position. So that's 1/3 of the, did I do a third? I think I did 3. Yeah. So that's one of them. The other two, one was PLD and the other was VICI. So let's go to PLD. All right. PLD. And again, this is the same thing. They did just have a nice earnings beat. When was that? On the 16th. Did I buy it before then? I think I bought it after that. Okay. But yeah, same thing. Pays $1.07 per share every quarter. And this is real estate that's real estate segment represents the ownership, development, operating large companies firm. Operates the real estate and strategic capital segment. Well, that doesn't tell us what they're. Let's see. Let me pull up their financials. We can see what they're kind of invested in here. So yeah, here you can see their dividend history. They've got a pretty good history of paying, not only paying a dividend, but increasing it. The yield, the trailing 12-month is 2.85%. So nothing crazy, but again, over time, that should compound nicely for us. Let's see here. Yeah, it's not gonna. Here we go. So here's our breakdown of the real. It's mostly in the United States. It's got a little bit of exposure to Europe and a little bit to Asia. But yeah, the vast majority of it, 8 billion is in the US, and then you got a couple $100 million spread around other countries. All right. So that's that. Again, with the drip on every quarter, those dividends will get reinvested. And then VICI, if I remember correctly, this is the one that owns a lot of like gaming, like casino real estate and stuff like that. Golf courses. Over time, and this one's going to be paying a really nice dividend for you. Yeah, and this is like gaming, hospitality, entertainment properties. So golf courses, casinos, hospital, not hospitals, hospitality, hotels and things like that. So exact same thing here. And we actually got a pretty, this is a pretty decent, and it's just been like trading in this range for the last 5 years. So maybe it stays in that range. Maybe it drifts a little lower. We're going to keep dollar cost averaging into it. And we're not even really going to concern ourselves with these for the next 5 to 10 years is sort of the idea. You're not going to notice anything with the compounding for the first 10 years, which is why it's not a lot of people do it, because it's not really sexy. And I think you kind of lose a lot of people lose the will to maintain it. And they get impatient because you don't really notice a lot of the legwork has to be put in, which is why it's ideally you get started doing this in your 20s. So you have, fucking 40 years worth of compounding, because in reality, the first like 10 to 15 years, it's just sort of laying the foundation to go parabolic. So for the first 5 years, you're not even going to notice anything really, unless the stock goes on a crazy tear, which it probably is not going to happen. These are not like super high growth stocks that we're looking for. We're looking to build a position that when the time comes, when you're going to sort of switch over from your regular 9 to 5, getting a monthly paycheck, to living off of the dividends that the portfolio is paying you, this stock in particular pays a 6.84% dividend. That's nice. So we're going to we got to start acquiring shares of this over time, so that 15, 20 years at the 20-year mark, you really see some nice compounding. Again, we're trying to do that. We're trying to do this in faster than 20 years, but this will be one of your longer term positions, or something like this would be one of your longer term positions. It's going to set you up nicely for dividends far into the future without taking on a ton of risk. I mean, it's a good way of getting real estate exposure. So between those three, I think we have like the three best sectors of real estate to kind of have our be wetting our beaks, so to speak. And every month we're going to take, again, just 30%. Remember, every month we're going to add $5K to this portfolio. And so 1,500 of that will just be split between these three stocks. So every month we're going to buy more, and then every dividend we're going to buy more, and we're going to just let those positions build and let the compounding do the heavy work for us. So that was pretty much all I did last week, was get into those positions. And then I did a forward put that we already talked about. I think that's everything we have in the portfolio here. So while I have this chart up, before we look at the portfolio overall, let me just the next moves I'm going to be doing, and these are going to kind of be the main staples of this portfolio, again, because I don't really know people's specific situations and everything. I can't, and I'm not authorized or certified to give investment advice or anything like that. But this is, so the next two moves that we're going to try to get into are not going to be individual stocks. They're going to be ETFs. There's going to be the NASDAQ and the S&P 500. Ideally, you'd be able to buy into these straight up because you have enough capital to acquire at least 100 shares. Since we don't have that, they do have these ETFs. The first one I'm going to pull up is QQQM. So QQQ would be the NASDAQ ETF. But if you look at QQ, let me just show you what QQQ looks like. Okay. I think it's like $700 a share or something. Yeah. Okay. So this is basically going to track the NASDAQ. And it's after a pretty substantial pullback. I think we pulled back about 10% from the highs so far. It was tempting to start dipping our toes in a couple days ago, but I did just, yeah, it was down 11%, 11.72% from the all-time highs. I did think about on Wednesday buying something, but I just see another leg down, to be perfectly honest. So we're going to try to be a little patient here and see if we can get a better entry. And that could fuck us. Like that could have been the move down. Maybe we're only going to get a 10, 11% retracement and it's going to go towards all-time highs. I don't see that in the chart yet, but it is always a possibility. But since this costs $688 a share right now, that's just too expensive for us. We're not going to be able to buy enough shares like ever. Not ever, but for a while. Ideally, the goal here is to acquire 100 shares so we can start selling covered calls on the position when it's strategically advantageous. Okay, so the best way I know to do that is to get into these. These are basically micro shares of the exact same thing. So you can see this chart looks exactly the same, except we can buy this one for $283. Much better. We'll get to 100 shares a lot faster that way. Okay, so and these are going to be what we're going to kind of depend on for a lot of the growth. In the portfolio, just overall, you know, you're going to get the NASDAQ, and then we have the same thing for the S&P. You can see I drew just a simple fib here. Again, swing low to swing high. We have not moved below the 50% mark into discount territory. So my ideal entry, and look how this 618 retracement at $259 a share lines up with all this previous support right here. So it's certainly not out of the realm of possibility that over the next couple of months, we come down and test this previous resistance and see if it will hold as support. So we might just be taking short-term trades and trying to generate capital for if and when that happens, or we might just start dollar cost averaging in. I haven't decided how I'm going to play this yet, but we're going to be buying this, the NASDAQ, and SPYM is the S&P 500 one. You can see the S&P 500 has held up a lot better than the NASDAQ. It doesn't have all the tech exposure. So yeah, and it's kind of weird. If you look at there's also one for the Dow. DIA. DIA is that it? I think that's the regular one. Yeah, maybe DIAM. Nope. Okay, I don't know. I'll have to look that up. Here's the one for the Dow. So the Dow and the S&P have held up a lot better than the NASDAQ. And you have to wonder, are they sort of the sick sisters of the NASDAQ and they're eventually going to take a nosedive themselves? Or is the NASDAQ the outlier and it's going to rebound and work its way up to new all-time highs as the S&P? And I mean, this kind of looks really nice, really poised for a nice pop up. But again, you can see that the indicator I have on here is telling us that it's a sale until this fails. But yeah, I got some relative equal highs here. But it also could just chop around in this range for a really long time. I mean, markets go up, they go down, and they go sideways. So we're going to be buying this. It's $87 a share. So we'll probably start getting into this. And, you know, those are going to track the markets for the most part over the next, however long we hold them. We'll keep adding to those positions. And eventually, hopefully, we'll be able to sell covered calls on the positions. And I might use puts to get into them. I might sell some puts and collect premium until we get assigned the shares. Once we have the funds to do it. That is a good way of getting into positions if you're not in a hurry and you're not afraid of the stock running away without you. Yeah. So those are the next two kind of positions I'd like to start building out in this. And then here is let's move that. Stop sharing. Just show you the actual portfolio so you can see what it looks like. It's right here. Wait, it was right there. Where did it go? Nope. The fuck? You're gonna do this shit again? Did this to me last time. I remember this, and then it appeared. Made me look like a fucking retard. Window. Come on. Nope. It's not going to do it. Well, fuck you. I had it up before. All right. I don't know what the hell that is. But, okay, so we'd have the individual Amazon position, grab position, the Russell 1000 position, and NVIDIA. Those are all options, that long-term options that don't expire for at least a year, pretty much. NVIDIA, what did I say? It's like March of next year or something like that. April. So we're not gonna play the S&P and the NASDAQ with options. We're gonna buy those outright. Try to acquire 100 shares and start selling covered calls when I think it's strategically advantageous. And then we'll continue to make plays that are sort of more asymmetrical, like the IWB. I would say is an asymmetric bet. NVIDIA and Amazon and Grab are just sort of ways of playing positions that I'm long-term bullish on without tying up a lot of capital. But yeah, one of the ways that we will hopefully generate some outsized returns is through what I call asymmetric options trades that are going to be high risk, high reward. Very good chance they go to zero, but if they don't go to zero, there's a good chance that if they hit target, they're at a minimum, it'd be like a 5x trade. Wouldn't put it on if I didn't think 5x was a strong possibility. 5 to 10x is what we kind of aim for. So, yeah, I think next month we still have, I mean, technically we have $6,400, but 19 of that is basically tied up in the HYMC put dedicated to that. So we got about $4,500 to invest right now. And starting tomorrow or Monday, since the markets are closed, we'll have another 5K to play around with. Again, 1,500 of that will be put into those real estate stocks. So the other 3,500 with the 4,500, we're going to start using to build out positions, take some more options trades. If there's anything, I have some on in my actual portfolio that are still viable trades, and maybe I will add those to this portfolio. Just kind of depends on what happens with the markets. I wish you guys could see that. I hate looking at it, to be honest. I really don't. I haven't liked this platform. I haven't gotten used to it, but basically let's see. Our P&L for the day, we're up $2,483, $2,483. We've got $4,500 in available funds for trading. Our P&L for the year, we're down $187. That is, yeah, what's making that up? The NVIDIA trade has 1,200 of open negative P&L. They're considering the HYMC trade. Well, that's basically about break even at this point. But yeah, technically that's taken away 1,900 of our purchasing power, but that's not counting really much against our P&L. IWB is 375, down 375. So that's the main bulk. And then Amazon's up 1287. DLR is up 132. So that's kind of where they're getting the 300 and our open P&L right now is down 310. Our P&L for the year is down 187. So that's the difference between those two are the premiums that we collected from selling puts. So maybe we'll sell one more put to get that P&L for the year positive. But again, these are, those are going to fluctuate. We're not really going to concern ourselves with NVIDIA or IWB or even Amazon for that matter right now. Those are longer term holds. We're not going to get caught up in the short term noise. But that is the business. There's your portfolio update. Like I said, I did try to place a couple trades today. They just didn't get filled. Yeah, I tried to sell a put, didn't get filled on HYMC. And that's not a big deal. Honestly, I was kind of glad that didn't get filled. Yeah. So again, like I'm not trying to have this be a thing where I pick individual stocks for you guys. Like I'm picking stocks that I think would be sort of representative of a portfolio, of an average portfolio, of like what somebody might want to do in this sort of hypothetical position. And then how to manage the positions throughout the ups and downs of the market. So keep all that in mind. Again, this is not a signal service or anything like that. I mean, you're welcome to treat it as that, but that's on you. These are, I'm not pressing that button for you, and I'm telling you actively not to do it. But if you're looking to get into positions in your portfolio that are in these same sectors or something, you can kind of mimic how we handle them, or learn how to manage positions and generate extra income along the way, manage risk, those sorts of things. That's kind of what we're trying to do here. And yeah, we'll see what's going to happen with this AI stuff. I mean, it was a really bad month and a half, 2 months, really. June and July, basically, the AI trade has collapsed. So is it done collapsing? Hard to say. But that's going to be some pretty strong headwinds for the NASDAQ in particular, if those continue, because those were basically, that was the only reason that it was going up pretty much. Anyway, getting kind of long-winded here. It is Friday. Oh, I think we're going to do a happy hour. I forgot to send out the email. I should send that out. Yeah, we'll do a happy hour here at 6:30 my time, 7:30 p.m. Central. You guys are all welcome to join. If you actually get to this before the email, probably wouldn't, considering it's already 4:30. And you're probably out there enjoying your Friday afternoon. But again, yeah, if you have any questions, throw them in the comments. And oh, I just remembered somebody had a question, and I was trying to figure out how to answer it. I had to log into the Substack or something, and it was annoying me. I couldn't just do it from my phone. I'll do that right now. So there's the business. We'll check back in next week. More to come. Until then, you guys know what to do. Just keep on peddling that so-called fiction. Peace.